Joining me right now is Independent Advisor Alliance Chief Investment Officer Chris Zaccarelli. Chris, good to see you. Thanks very much for being here. I want to talk yields with you. Recently, we've been talking about the story that interest rates have backed up so much that now people are suggesting that the market has done the work for the Fed. Are you expecting a rate hike at the Federal Reserve's next meeting as we look at the 10-year and the 2-year this morning?
We think it's unlikely the Fed's going to raise rates at the next meeting because of what's happening within the Middle East and because rates have gone so much higher, as you pointed out. The jobs report last Friday was very strong. We do have a CPI number this morning. If CPI comes in hotter than expected, that could put pressure back on the Fed to raise rates. But at this time, we're expecting the Fed to stay on hold again and wait and see what happens with inflation. This morning's data will be really important because the core number, if it comes in much above 4%, I think that puts pressure on them. Otherwise, I think they could stay on hold, and that is our base case.
Yeah, I mean, the consumer price index is out in about 2 hours, 15 minutes, and we are expecting a gain in the CPI. We got a similar situation yesterday for the producer price index. We know that oil prices have been spiking, and that has been undermining any effort to take inflation down. What are your expectations for the CPI, given what you heard yesterday on the input level with the PPI?
So the PPI was higher than expected. That surprised us to the upside. We are expecting CPI to stay in the low fours. We don't know if it'll come down much from the 4.3% that came in last time, but we're expecting if it does come in less than expected, it'll be a little bit closer to 4, so call it 4.1%. Still double the rate of where the Fed wants inflation to be, but it has been coming down. And like we said, as long as inflation comes down, there'll be a little bit less pressure on the Fed to raise rates this time, given how much longer-term rates have gone up already.
Yeah, we just looked at the PPI numbers, up 0.5%, better than higher than the estimates. Now, this morning, the expectations call for a gain of 0.3% year over year and a gain of 3.6% year over year and 0.3 month over month, rather. The minutes from the Federal Reserve September monetary policy meeting also out this week, showing that officials, quote, restrictive policy will stay in place until inflation eases. What do you think that means?
So I think at this point, the Fed is letting us know that they think rates are at the appropriate level. On the one hand, they think they're high enough in order to contain inflation. Like we said, if the inflation numbers come out higher this morning, that could change that calculus. But on the other hand, they want to make sure that they don't raise rates too high and cause a recession. Right now, they feel like the risks are balanced. So in their mind, rates are high enough for where they need to be contain inflation, potentially keep the economy going at its current level and not cause a recession. And really, the big news for investors, which is something the Fed has been saying all along, is that they're going to keep rates higher for longer. They were going to raise rates to some particular level, let's call it 5.5, which is where we are now, and then hold them for 6 months, 12 months, maybe for a long period of time. Up until a couple months ago, the market was expecting cuts for next year. We think it's unlikely the Fed starts cutting right away unless there's a big economic drop-off. And even in that case, we think they'll let the economy go for a little while just to make sure inflation is in check. This is a different Fed that we're seeing right now than we've seen over the last 20 to 30 years. So I think if people are looking for a playbook, they should be looking back to the 70s and 80s, not as much to what we've seen since post-global financial crisis, where they've cut in advance or concurrent with a downturn. This time, they think they may be a little bit slower to cut rates and just keep them higher for longer, even if we start heading into a downturn.
Yeah, and that, Chris, final word in terms of where this macro story goes.
Yeah, I mean, I think we've been really surprised at the resilience of the consumer and the fact that, the unemployment rate has stayed so low. I mean, ultimately, if the consumer remains resilient, unemployment remains low, we could see this economy go on for much longer than any of us would have expected. And that recession that will eventually come may be farther off into the future. We don't know if it comes next year or the year after, but clearly, higher rates will have an impact at some point. I just think the biggest surprise has been how long it's taking, how long those lags are. And in the meantime, the market can continue to go higher as long as we stay out of recession.
Yeah, it's true. This has taken longer than so many expected in terms of that downturn and the impact of 11 rate hikes from the Fed. Chris, thank you. Good to see you. Chris Zaccarelli joining us this morning on Markets.